I think this space is going from 2.5 trillion to maybe 12 trillion this cycle to 100 trillion by, let's say, 2032. That'd be the largest, fastest wealth accumulation of all time. $1 trillion of new wealth created, which would be the largest amount of new wealth created in all history. That's, by the way, twice the size of the 100-year accumulation of wealth of the S&P 500, just to get your heads around what it is. Maybe I'm wrong. Maybe I'm wrong by 50%. So 50 trillion. So it's the same as the S&P over 100 years. 25 trillion, half the amount the entire US economy had generated in equities over the last 100 years. It's bananas.
Raoul Pal is the founder and chief executive officer at Real Vision and global macro investor. The renowned macro analyst and crypto enthusiast is ever bullish on crypto asset prices and technological stocks, which he describes as the only true winners of the exponential age. According to Pal, crypto is by far the best investment opportunity that has ever been given to retail investors. Not only does it present a rare opportunity for retail investors to get ahead of fiat currency debasement, but it also provides a leveling opportunity that can never be found with other asset classes. Like other crypto enthusiasts, Pal is exceedingly bullish on crypto asset prices in 2024 and 2025. Before the cycle ends, he predicts that the overall crypto market cap will hit a new all-time high of $12 trillion, which is about quadruple the current range of $2.65 to $2.7 trillion. This will easily take individual crypto prices to new all-time highs. Pal's target for Bitcoin is at least $200,000. He also has an $8,000 prediction for Ethereum and a $1,000 prediction for Solana. We will now bring you clips from Pal's recent video broadcast as he delves into his predictions and outlook for the cryptocurrency industry in 2024 and beyond. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also join the conversation by dropping your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
So given that all assets are driven by debasement, everything is basically driven by the business cycle, and everything is correlated. Some things lead, crypto and technology lead. As the business cycle bottoms, so ISM comes across 50, commodities and cyclical plays come into play. There are some lagged things that come behind, real estate and stuff. But anyway, business cycle rules it all. Everything's highly correlated. It's all driven by the everything code. So the dirty secret is this is the easiest fucking game in the world. You just divide all the asset prices by each other, look for the best performing asset. So that's what I did. And that's what I uncovered. And that's what changed everything about me. As you know, I've been involved in crypto since 2012. But I really started to realize that if I divide S&P by crypto, it's down 99.98%. If I divide gold by Bitcoin, down 99.99%. If I divide oil stocks, if I divide emerging markets, if I divide world equities, 99.9%. They're all down since 2012 versus Bitcoin. And technology, the secular bull market that's made everybody a fortune, down 99.93%. Right. So everything goes down 99.9% over time versus crypto. But it's not over that, 10 years time horizon, 12 years time horizon. Actually, when you look at it, crypto is the best performing asset in the world, 3 out of 4 years. Fourth year, it's the worst performing asset. Then it's the best performing for 3 years. Then it's the worst performing. This keeps going on. Bitcoin, even with 3 or 4, 80% drawdowns-ish, 75, whatever the average is, still has done about 140% a year returns. Let me just repeat that. Annualized return of Bitcoin is 140% a year since 2012. You can own any VC fund. You can have any other asset class. Nothing comes fucking close. 20 million % returns since 2012. 20 million %. Since I started Real Vision, Bitcoin is 450,000% returns. And we started talking about it. But ETH came a cycle later, a couple of cycles later, actually. Well, ETH is about 160 something percent, 165% returns annualized. Been around less. Solana, 200% returns annualized because it's been around less early on the network effect. I don't know if you can get your heads around this. And if you're not a crypto investor, I simply don't understand why, when you've got the best performing asset class of all time, the fastest adoption of any technology in all time outside of AI, the largest generation of and fastest generation of wealth in the shortest period of time, why you'd not be involved? It's just bananas to me. It's a scam. All you're doing is helping yourself disappoint your future self, right? An asset is future deferred consumption later. And you want your assets to be worth as much as possible because you're taking risk with that money by locking it up. So therefore you should be compensated for that risk. Your future self will go, well done, Raoul. 10 years ago, 15 years ago, you bought this stupid thing called Bitcoin and it's now up 20 million%. Thank you. That's great. I can go and buy a house or go on a world cruise or buy a mega yacht. So anyway, that's what I got to. And it's not because I'm like this singular focus, Bitcoin or blockchain or crypto is everything. It's because it is everything.
In previous interviews and tweets, Pal has discussed the great and unmistakable correlation between the business cycles, global money supply, and asset prices. His new thesis, The Everything Code, gets deep into that correlation and how it can help investors appropriately time the markets. Pal believes the liquidity cycle occurs about every 3.5 years, with an intermittent slowdown period, usually signified by a recession. According to the macro guru, we bottomed last October, and the printers are about to come on again. In his video, the former Goldman Sachs executive highlights 3 major reasons why central banks are about to resume money printing, and how their activities will contribute to significantly higher prices for crypto assets. Here are more clips from the video.
At the phase where the Bitcoin halving is happening, the election cycle where they give out free candy to the kids, stimulus, and we generally get, well, we've got the central bank who want to cut rates, even though inflation's not playing that game. We'll talk a bit about that in a sec. And then we've got global stimulus cycle from the weekly global liquidity index, which has been rising. So this is the part where liquidity starts going up significantly. The Europeans are going to start cutting. We've already seen, I think, the Swiss cut. We're going to see a few nations cut. Latin America that was first to hike started cutting. Brazil. So we'll see the cutting cycle, global cutting cycle will pick up. We've got China with a very lackluster economy. In fact, it's a debt deflationary trap driven by an aging population and excess debt. We all know about those things because we're all living in one, whether we're living in Europe or living in the US or Japan. So they're going to stimulate more. The Japanese are pretending to raise rates, but they've still running kind of negative interest rate policies when you look at it in real terms. And we should see inflation continuing to slowly decline. Now, it's been flatlining for a while, but many of you have seen me tweet out a chart of previous inflation cycles versus this one. It always has this flat bit, then it hooks down. If I look at the Truflation Index, the guys at Truflation have this real-time inflation index with millions of prices. That thing is now at 1.78%. It's falling. I know nobody believes me. Either way, the Federal Reserve want to cut rates. Why? Because of the Everything Code. I've told you about the Everything Code. If you've not seen it before, please watch the YouTube videos on the Everything Code. The Everything Code basically suggests that they have to use liquidity to monetize the interest payments on the debt. We're coming into the teeth of the interest payments now, and we're paying for the interest for the debt we issued during the pandemic. So we got a lot of payments to do. The bond market's freaking out from this, obviously, because they're like, how can we pay for all of this stuff at 5.5% rates without issuing more and more and more debt? Gold market's breaking out on the back of this. And so it should be, because the answer is going to be they're going to have to use liquidity. Will they use quantitative easing? Probably not. Why? Because we all know the trick, and we know the name quantitative easing equals money printer goes burr. So what will they do? Well, they've been running down the reverse repo. That's okay. It doesn't matter what the format is, but they've been running down that, which means banks have been putting money into the market. Then they have been they're still doing quantitative tightening, but they're already talking about, well, at some point we need to stop that. Of course they do, because the reverse repo is almost empty. That runs the Fed out of opportunities at this point. Next part is, what do the Treasury do? Because the Fed is basically just helping the Treasury now. Well, the Treasury's been building up the Treasury General account. That's their bank account. And then what they will do is start running that down over the election, which is liquidity flushing into the system. We've got to get through, I think Mike Howell talks about this. We've got tax season, and often that takes money out of the money markets, and then it goes into the Treasury General account, then it gets drawn down. Some people think that's liquidity negative. I'm not entirely sure. I think, but in the end, the Treasury General account will be like $1 trillion, and they'll inject that $1 trillion nicely back into our hands, and number go up. And then all the other nations around the world were doing something similar. Then we've got probably Basel IV, which is next year. Basel IV is even tighter standards that means that the banks have to use more regulatory capital, which means they need to own more bonds. Clever that, right? Find a way for the banks to own all the bonds so you can keep issuing them. Okay, they're all doing that. So that's about to happen. Rolls out in, I think it's the UK first or Europe first in like January. And then, I think the UK's following the US, which is July. And I think Europe's in January. So we've got that whole liquidity event to come. Then we've got Oh no, the commercial real estate market, the banks are stuck with this. What do we do? Oh my God. Let's absorb it onto our balance sheet.
Pal is predicting a 431% increase in Bitcoin's price before the cycle ends. His predictions for Ethereum and Solana are even more bullish. He expects both to gain around 700% and 852% from their respective lows before the cycle ends in 2025. Pal says he's generally bullish on asset prices both in the short and long term, because central banks will keep pumping money into the economy, providing the markets with adequate liquidity to keep asset prices up indefinitely. But the flip side, according to Raoul Pal, is that the traditional asset classes are not actually growing in real terms, just responding to the continuous liquidity pumps without any real appreciation in value. Because the liquidity being provided potentially means continuous currency debasement without any real increase in purchasing power. What are your thoughts on Pal's predictions for Bitcoin and the overall cryptocurrency industry? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.